their personal story is really important. What drives them? What kind of person are they? What's their backstory? Why are they passionate about this particular problem? I prefer it if they have knowledge of a particular industry. I know there's two schools of thought, right? An industry outsider coming in to solve a problem might see things and do things and disrupt things differently. The thing about early stage ventures, it's a lot of it is access to deal flow. So a lot of it is credibility, friendships, relationships, and then access at the right time, very early, where it's not well-known mainstream.
Welcome to the Alphapreneurs podcast. I'm your host, Rayhan Aleem, founder of Taxstar and Alpha Pro Partners. Join me on each episode as we talk to inspiring Dubai-based entrepreneurs who share their stories, challenges, and secrets on building world-class businesses. Tariq, welcome to the show. Thank you very much for joining us today.
Good to be here.
I want to just get into 𝗪𝗪 Ventures. It's one of the projects that you're working on. You have a lot of your investments in there as well. Do you want to tell us more about 𝗪𝗪 Ventures? What made you, create an entity? What are the objectives? What's the journey been like so far? As an investor.
It's been quite an interesting journey. I mean, I moved to Dubai. Just to give a little bit of the backstory, I moved to Dubai in 2003, so just over 20 years ago.
Wow,
quite a while. Yeah, I mean, people say, "Oh, you were here so early in the Dubai journey," but actually, when I came, I felt I was late. There was a lot going on in Dubai, and people had been here for quite a while already, and there was a lot of dynamism, and it just, Dubai has just continued to build, and the momentum of the Dubai story has just continued to accelerate. So, I didn't feel like I was early at that time, and I was originally part of the founding team at the Dubai Development Investment Authority, which was His Highness Sheikh Mohammed bin Rashid when he was the Crown Prince. It was kind of his, private, it was government, but it was where he was developing a lot of the diversification of the Dubai ecosystem and helping to build different sectors, hospitality, leisure, entertainment. Healthcare was one of them. And so I ended up, building, that was the start of my healthcare experience and career, building companies and building healthcare businesses here in the region. So I was part of the team that built Dubai Healthcare City. Had my own healthcare financing startup with a business partner of mine, and we raised venture capital. 𝗪𝗂𝗪 Healthcare,
Nice.
providing healthcare financing for elective treatments, things not covered by insurance. Quite early in the cycle, this was back in 2008, 9, 10. Went down to Abu Dhabi, was part of the leadership team that built Cleveland Clinic in Abu Dhabi with Mubadala Healthcare at the time. And I'd been there for 8 years. That was a huge project. Joined in 2010. We launched Cleveland Clinic Abu Dhabi 2015. Stayed there till the operations stabilized early 2018. Very successful project. I was very blessed to be part of the team there from very early. I think I was employee number 21 or 22 on the team. We were working out of a residential apartment that was owned by Mubadala opposite Mamor, their headquarters.
Wow.
So it was a residential building, and that's where me and the head of pharmacy started working with our laptops out of a bedroom in one of their residential apartments. So true startup, but just, sovereign wealth fund backed.
Yeah.
So once that project was completed, I've been there for 8 years and I rolled off. I thought a lot about what I wanted to do. And there was a lot of interest in kind of early stage venture, entrepreneurship. The government was really pushing it. There was a lot of, it's very well known for the SME sector here in the UAE already. So, and there's a good entrepreneurial spirit. So they were really trying to harness that. So I really wanted to kind of get into that space early. And I'd already set up my own company, financing company early, raised venture capital, built companies for the government.
You've had the
here.
experience before.
I'd had experience all my career. I've kind of built startup companies. Even in London, before I came to Dubai, I was working in telecom startups in the city. So I wanted to get into that space, and I was a bit disillusioned by healthcare as well, which I spent 15 years of my, about 15 years of my career here in healthcare. Very important industry. My parents are, my father's a surgeon, retired, mum's a midwife, so came from a healthcare family, but not the most dynamic in terms of, entrepreneurial, disruptive offering in healthcare. It's a very regulated environment, patients' lives at risk, so it's fairly cautious, a lot of scientific journals, and they take their time. So And there was a lot of activity happening at that time in the fintech space. It was kind of early days, 2018.
Yeah.
B2B SaaS, there was some interesting stuff going on. So I set up Janus Ventures originally to work with early stage founders and companies, and to help them develop their scale up strategy, help them to develop their offering across the
Use
region.
your expertise to kind of help them.
Yeah, so a lot of them, a lot of the entrepreneurs and co-founding teams, they didn't have much budget, much capital, right? And they wanted people with experience, expertise. I had a variety of different expertise, mostly in healthcare, but with a lot of early stage building companies, early stage startups. So I set up Janus Ventures originally to kind of do some fractional advisory work, CFO roles, COO, board advisors, commercial roles, helping to bring companies in. So, the home markets that I've had experience in the UK, UAE, kind of a bridge to bring in companies from the UK or Europe into the region. And I did that with one group, Proximi, or working with early stage companies here that wanted to, tap into expertise that they couldn't really afford full time. And that was really how Janus Ventures started. That was the concept. And then the journey just evolved, and I started getting, once you get deeper down the rabbit hole, lots of things start to present themselves and opportunities.
So so I take it you found opportunities and you thought, okay, this company looks quite interesting, I'd like to put my money in there, or was it a pull? Did they come to you and ask for money? How did that work as well when you was, adding it to your portfolio?
Yeah, it was more the former. I mean, what happened was it kind of organically developed. So I started working as a kind of fractional commercial role for a group from the UK to come into the region. Then I started to build a portfolio of 2 or 3 different advisory mandates concurrently. One in the Salesforce sector, another one in the energy, oil and gas and energy sector. And invariably, all of them were either looking to raise funds, were looking at scaling up and trying to build a proposition so they could then go out and raise funds at a better valuation, or bring in debt, if equity didn't make sense to them. But all of them were looking at needed working capital, needed growth capital. That was the kind of the commonality across all of them. So I helped raise a debt instrument. I have a finance background, I'm a chartered accountant from the UK and a lot of finance experience. So we raised a debt instrument for one of the groups. Another group to help them close their Series A funding round, equity round. Another group we kind of positioned for an acquisition, which took some time. But so what happened was from there, I started to get experience of the kind of fundraising, debt and equity side. I started to get more involved in the ecosystem, and I started getting invited to come in as a mentor in some of these accelerator programs. I was invited with the 𝗏𝗏 program, 𝗏𝗏𝗏𝗏 program, to come in as a mentor, and there was a few others that invited me as a mentor. So I started getting exposure to very early stage entrepreneurs and founders, and that seemed to resonate, and it resonated 2 ways, from me to them and them to me. And then it didn't take long, and then I started getting access to opportunities to invest, because a lot of the founders I was working with or became friends with or was in the ecosystem with were starting to raise. And then the thing about early stage ventures is a lot of it is access to deal flow. So a lot of it is credibility, friendships, relationships, and then access at the right time, very early, where it's not well known mainstream. So a lot of these opportunities started to present themselves. I set up Janus Ventures 2018. 2020, so 24 months later, it was a very accelerated journey. Then I started getting opportunities to put some money in early off my own balance sheet, which is always nervous when you cut your first check, hard-earned dollars, and there's a bit of a leap of faith in there. And then did my first angel investment early, worked out very well for me and the other syndicate of angels I went in with, and I've done many more since. I mean, once you kind of break the fear barrier on anything in life, actually, then the second one and the third one becomes easier and easier. And it doesn't necessarily mean that they are going to be more successful, but you just get more comfortable with doing it.
Yeah. Now, I guess, even with VCs, they're, in their portfolio, they may have 20 companies, and of the 20 companies, 1 or 2 may be a unicorn, right? the others may not do so great. And I guess as an investor, is that how you see, as an angel, is that how you see your portfolio? Where you see maybe one of the 10 or one of the 20 will become the unicorn, and the rest may not do well. What's your kind of mindset when you invest in startups?
It's a great question, actually. I mean, I didn't know much about venture investing, when I first started doing it.
Yeah.
Not too long ago. I mean, we're talking 2020, just 4 years ago. It wasn't. It's not like I've been doing this for 2 decades. And
but you have some great companies in your portfolio, though.
Well, yeah, I mean, there's some great companies. I would say there's some great founders.
Yeah.
But as a result of the founders that kind of I've been fortunate to kind of come across and get involved with and put some of my money, but they create good companies, by brand and by reputation. Reputation. Yeah, good leaders, good founders. They tend to do the right thing, get good people around them, and then hopefully good things happen. But a lot of them are still early, right? So they can be good by reputation and good by brand, which is very important. But obviously, as an early stage investor, you want a multiple on an exit,
of course.
And so that that for many of them remains to be seen how well they will do. But hopefully, there's some winners in there. Yeah, I mean, for me, to be honest with you, I mean, I'm a big believer in learning by doing. I read a lot of books around the topic, early stage venture, the legalities of it, notes and structures and safes and terms. And I did a lot of reading around it, academic reading. But to be honest, when I jumped into this, actually putting my money into companies, I didn't really understand a lot of what it meant. And you don't really appreciate the nuances of the technicality of these things until you start to have some experiences.
Yeah.
With them. Things actually happen, and you get diluted, or you have the opportunity to take pro rata, or someone else on the cap table has an MFN, and what's that? So a lot of these clauses that I didn't I've read about but didn't really understand what they meant.
They're quite new clauses as well, right? So like the safe agreement, which 𝗏 kind of invented.
Yeah,
a lot of these are new terms as well.
Yeah, I mean, it's become like the de facto investment document. The safe. There's the other group, I forget the name of it, they have a KISS document, and in London I've invested in some startups. They use an ASA, Advanced Subscription Agreement, which has a 6-month drop-off date, so where you automatically convert to the cap table. But here in the region, certainly safes, and YC safe is the go-to, and it's pretty standard. But what you learn is that knowledge is power, and also leverage is power. So a lot of the VCs that have good reputation, they've got big funds behind them. They know they can really, especially the accelerators, they can get very good terms. They can make sure they get certain clauses that are important to protect. Right. So everyone hopes that everything goes out really well and everyone wins. Yeah. But in downside scenarios, there can still be some winners in that. It's a zero-sum game, and so there can be some winners at the expense of others, and those early clauses that you get locked in become important. So just to come back to your question, I mean, when I started, I didn't really have much of a strategy I didn't really know what I was doing, to be honest. I was getting access to various different deals. Some of them were pre-seed, first money in, paper business plans, really interesting founders or founder. Some of them were different geographies, US, later stage, Series A, beyond, that I had just happened to have access to through the network. Others were kind of pre-IPO or much later growth stage rounds.
Yeah.
And there were secondary opportunities, much higher valuations. So I did a bit of everything. And then over time, I started to refine my thesis about what it is I was looking for, what stage did I want to go in at, what did I feel was a good ticket to kind of put in. But always from the beginning, my kind of vision was, I wanted to kind of be in this industry long term.
Yeah.
I continued to build companies, in the health, my kind of bread and butter industry, healthcare industry at the moment. We can talk about that later. But I always wanted to stay in the venture space as an early stage investor. Maybe in time have my own fund, with a fellow GP or solo GP, or deploy capital on behalf of family offices alongside my own money. So in time, I started to come to the conclusion that what I wanted to do is take a kind of institutional VC approach, right? So take a portfolio approach to my investing, and then once I'd done 6 or 7, I knew that I needed to kind of reach probably about 10 minimum investments, anyway 10 to 15, because then you're diversified. Try and be a bit more consistent in terms of stage I'm looking at, sectors I like, sectors I'm going to kind of steer clear of that I don't know well enough and it's just not for me. And then in theory, like you say, that one investment will return the fund in time, right? That's how VCs do it. They want a unicorn or a double-digit multiple return on their money, returns the fund, and then everything else is upside. I think it's challenging to get those unicorn exits in the region. We're still quite early.
There hasn't been that many. I mean,
there's about 10 to 15 in the region. Increasing numbers coming out of Saudi. Saudi is an interesting market, right? Everyone knows about 𝗏𝗏 and Souk and some of the other kind of more well-known ones, fintech in Egypt as well. But a lot of them in Saudi, Jazz, unicorn exits. And but I think if you even if you, as an early stage investor, especially as an individual, when you're investing off your own balance sheet, what I've come to realize is that what's really important is to get an exit of your money. You want to put your money in, let it grow, contribute, support the founders as much as you can, and help them wherever you're able to kind of add value. And then if there's an opportunity for an exit, and I learned this fortuitously, I had the opportunity and I wasn't sure, should I stay in, should I go out? There's a very close friend of mine. We went out, the Angels, and it proved to be a really good call for us at that stage. You get your money out and you get a good return on your money, then you can recycle that and put it into
as an angel investor, what's the duration? So for the entrepreneurs out there who are looking to get angel investors on board, what kind of timeline should they be looking at in terms of giving them an exit, in your opinion anyway?
Yeah, really good, very good question. I mean, so there are different categories of investors, right? You kind of got individual angels that maybe come in early, maybe even before institutions. You kind of got the seed, pre-seed, seed, kind of first institutional money in. Then you've got kind of later stage growth VCs as well. So they all have different kind of lenses and different horizons. I would say for the angel segment, if we just focus on that, if the ecosystem here in the region, which is still fairly new, want to, and it becomes a community. So entrepreneurs are, you're helping current generation of entrepreneurs, including yourself, and also later generations of entrepreneurs. I think they need to, be cognizant of the fact that if they can give angels liquidity events and exits, they're much more likely to recycle that money, tell friends, maybe put bigger checks in and put more money into the ecosystem. And the angels are really important because they're typically the people that were, you've got friends and family.
They're the backbone of startups, right?
I mean, they're the segment that will put money in really early.
Yeah.
A lot of it on faith, a lot of it based on the relationship and their belief in the entrepreneur.
Yeah.
And I wouldn't say it's untethered or it's it's free money, but they won't have the pressure of LPs behind them and certain metrics they need to hit and certain milestones and certain time frames. So they can be a bit more patient, a bit more relaxed about the investment. It can cut both ways. You can get angels that are not very sophisticated, don't really understand it, compare it to real estate, and then they can be a real burden. So you want to get the right type of angels that get it and can be a bit more relaxed and a bit more patient. And that can really help the entrepreneur. It can give the entrepreneur room to breathe and to kind of try different things and test different things in the market. And, without having someone on their back every week, 2 weeks, month. Not to say that VCs do that. I mean, VCs actually, especially in the region, there's some really great VCs that can really add tremendous value. On the other side, angels, usually they have day jobs, right? So they're not always accessible. They can't think through problems all the time. A lot of it is to some extent a little bit of a hobby.
Yep.
So it just depends on the individual, where they are in their career. Do they have bandwidth they can contribute? Is there a genuine curiosity? If they're an industry angel in a certain segment and they've, typically they would gravitate towards company. It can work two ways. You can either gravitate towards companies and industries or you can gravitate away because the underlying problems or the infrastructural problems of an industry because you live and breathe it day in, day out with a day job and you tend to stay clear of them. So So yeah, I mean, they can be really helpful. So talking about exits, I mean, look, everyone loves to get, everyone wants to put money in, get money out 24 months, 36 months later, get 10, 15, 50, 100x return on their money. And, that's the dream. But I think if you're an angel and you put money in and you get money out within 36 months, 48 months, 3 to 4 years, that's a really good time frame. And if you're getting double-digit multiple of your money, 5x is great, 10x upwards, fantastic, right? The unicorn exits and the 100x, 150x, that's a dream for all early stage investors and angels. But you can still do very well even if you don't get any of those. You don't have to get a 100x return to do well. But then you need more than one winner if you're going to get, 10, 15, 20x returns. Yeah, there's no right or wrong way of doing it. It often just comes down to what you feel comfortable with.
I think what you said about the liquidity event, I think that's the key thing, right? You've given money as an investor to an entrepreneur. You want to see that money back because there's many situations, not in startups, but in general in business anyway. You invest in a business, and what typically happens is you don't see that money come back. And I guess that gives confidence in the investor community and you as an entrepreneur that you've taken the money and you've given it back. Obviously, you want a return on it, but the fact that you're able to give you were able to give the money back is a very important psychological thing as a founder as well.
Yeah, I mean, this comes down to point of view, right? It all depends on the lens you're kind of looking in at this arena from. I mean, from an entrepreneur's perspective, I would say, you always want to, have some kind of conclusion, right, for the journey. So some kind of exit at the end, some kind of return of money to your kind of initial backers and VCs and then their LPs. And, I think, an important part of the success journey is closing the loop on it, right?
Yeah.
Not all businesses succeed. Not all ideas work. I mean, the entrepreneur, which I find really, I have so much admiration for entrepreneurs because, they really have a hypothesis and they chip away and build a business to try and either prove or disprove that hypothesis. One way or another, they reach a kind of a conclusion on their hypothesis. So, but even in scenarios that don't work out maybe as well as, was hoped for, if you can, you get a trade acquisition or you get some kind of acquisition, where the whatever you've built, has created value and it goes somewhere, even if it's not a great exit for the entrepreneurs and they get diluted. I mean, I think that's always, I would say kind of the minimum, aspirational target for an entrepreneur. For the angel, you have to understand that this is a very high risk space to be putting money in.
Of course.
And 90% of startups fail. A lot of startups fail. The concept is good, they're getting scaled, but they may fail because they have liquidity challenges, founders fall out, regulatory changes happen. There's so many, it's like
many different things that
it's
can
an eye through
happen.
You right through an eye of a needle is, you're trying to, is the kind of path to success. It's a very, very tiny, margins either side, kind of, can fall off the wagon and not make it. So, I mean, so for angel investors, I mean, really, you obviously want to get a return. I always ask, founders when I'm about to put some money in, lots of different questions, but one of the questions I ask them is, what does the exit look like? How do you see an exit and how will we get our money back? And it's not to necessarily pin them down on it, but it's just to understand whether they've thought about it and whether they have some hypothesis about whether this could be an IPO type of business or a trade acquisition or a merger, or what kind of profile of companies would acquire them at what stage, so they've thought about who they're building for and what they see as a possible path to this journey ahead. Invariably, it doesn't, lead there, but if they've got that idea, then then that they've thought about the whole picture.
Yeah.
So for angels, you have to be prepared to lose everything, and and hope that you can get some money out. And if you're not comfortable with the uncertainty, or if you need that capital, should not be putting it into venture. I mean, you can put that in a bank and get your interest rate.
Makes
you can
sense,
buy some real estate and safe asset classes. And it's always good to diversify. So if you can have a bit, 5-10% of your portfolio into early stage high risk venture.
As an individual, basically.
Yeah,
not
obviously,
not as a fund, as an individual.
As an individual, I think, you should definitely have stuff in, your gold and cash and property, and, you need to have some money, in case things change, and depends on what stage of life you're at, kids and family. And, there's a lot of different stages consume more resources, and other stages, consume less resources. But, if you have a bit of capital available, then I think it's a good asset class to kind of get some exposure to and get some high returns. We're in a region that's still fairly new, right? So that's there's a lot of talk in the industry about path to IPOs, and do we have any IPO opportunities in the region? Will Saudi bring that to the table? There's a lot of over time. I think here there's a real willingness from the government and the leaders to really make this a sustainable industry over the long period, as they did with the aviation industry. Now we have some of the best airlines in the world out of here, tourism and entertainment. We have some of the best theme parks and hotels and resorts. So when they put their mind to something, and it becomes a sector that they really want to put at the core of their economy, then they back it. That's what they want to do with the early stage venture and VC investing. So we're still very much in the kind of early chapters of this story in the region.
So Tariq, one of the things every entrepreneur thinks about is an exit in their business. We personally worked together in one of these projects where there was a regional consulting company, and you managed to get them to exit to a global consulting company. I won't name drop, but I guess the question for entrepreneurs is, how was that process? What kind of things did you have to do to get the company ready for an exit? How was the negotiations? How was it post acquisition? Any thoughts on that?
Yeah, I've been involved in a few different transactions. So the one we worked on was a good outcome. I mean, I was retained as an advisor, a fractional CFO. So I had a CFO and COO. So I was running the operations of the business and managing the financial management and corporate finance alongside the founder and the technical team. And what I would say is, these type of transactions, it's always a meeting of, it's always serendipitous, So there's a meeting of two parties that want, one is looking for a new home, another party is looking to kind of grow and acquire as opposed to build on their own. So it's always a meeting of minds where there's an intersection where it's a genuine win-win. That's what happened in this case. We had been looking for the right suitor that could propel the business regionally.
So you was actually
forward.
looking for...
We'd been looking, yeah.
Okay, rather than someone coming to you and saying, we want to buy your business.
We had been looking, and we'd had a couple of conversations that were interesting, but there wasn't a good fit culturally. The timing wasn't right. And then once you start looking and you're clear about what it is, who it is, or what kind of organization you're looking for, and it's quite a well-known ecosystem. So there was some good players in the ecosystem that, once you start having that conversation, people keep it in mind, and there's some introductions, referrals are being made. And at the same time, you might find that there are other groups looking to get in. In this case, there was another group that was looking to get into the industry. They were in the kind of customer centricity space and the customer relationship management space. They wanted to kind of get into this kind of this software ecosystem. They didn't have any capabilities or talent in that space or experience. So it was a good fit. And, by us, you have to be careful, obviously, because we were not in a fire sale situation. We were looking for the right partner to propel the business. The business had been running for about 15 years. The founder on his own, and then we, grown to a team of about 35, 40 people plus in 3 different locations, 3 different offices. But the business had somewhat plateaued, and we needed fresh impetus. a backer, a partner, with resources that could really help us to grow and to scale. So that was really the genesis of the deal. Always in these transactions, I mean, there's a couple of key elements that need to be kind of thought through. You need to be organized as a company, right? And this is the arena we work in, right?
The numbers.
Numbers and audited accounts and financials and management accounts and, bookkeeping, tax filings, whether it's VAT, whether it's corporation tax, depending on which country and jurisdiction. You want all your legal documents well filed, your supplier contracts, customer contracts, any subscription contracts you have. So the more organized you are, the more chance you have, because unlike when you're in the early stage venture space and you're investing early at growth, the due diligence, especially in the early stage, is quite limited. Right. A lot of it is just the vision that the founding or the founding team paint, your belief in their ability as a unit to execute and deliver, and some of the initial traction and metrics that you're seeing, and to kind of get a sense of whether there seems to be some potential momentum there. When you're acquiring a company, I mean, they're acquiring, depending on whether it's an asset sale or whether it's a share purchase. If they buy the legal entities, they take responsibility of everything, all liabilities. So they have to have full visibility and due diligence, legal due diligence, finance due diligence, tax due diligence. They have to have comprehensive due diligence. So they know there's no hidden surprises, nothing hidden away. So if you're organized,
I guess you have to be open as well, right? Because if you go into a deal and you're hiding a few cobwebs in the cupboard and you don't, you don't be open about it, it's going to bite you later on down the line, one way or the other. And it's good ethical practice to make sure that you are opening from that point of view as well.
Yeah, there's a couple of things there, right? I mean, it always pays to be honest and transparent, with acquirers, with investors, and obviously you have to manage the communication, you have to manage the message, and you want to kind of convey it in the right way and the right time. But it never pays to hide things, because a couple of things happen. You hide things and they get discovered, which invariably they do when they've got accounting firms and lawyer firms. They will find everything eventually, and then the perception is that you're trying to hide away things and you're not being truthful and you're being dishonest. So you lose credibility there. And then also it doesn't lend itself well to a future relationship, right? Because if you bring things forward, challenges that are there, some outstanding legal cases that are there, and you can explain and put the context right and communicate it, that can actually work in your favor, right? You can build trust. They can see you as a trusted general manager of a business, someone that they can work with, right? So you can actually use what may be perceived as challenging situations actually and let it work in your favor if you can convey it in the right way. The other thing that's important, other than being organized and having all your ducks in a row and your accounting and bookkeeping and contracts, is that you need to have your investors, the owners of the company, aligned. So some cap tables can be very simple, 2 or 3 co-founders with some kind of family investors. Some can be very complex with multiple rounds, multiple institutional investors. But if there's a decision to exit, then invariably it could be a 51% acquisition, a majority position buyout, or it could be 100%. Usually it's 100%. And then everyone who's on the cap table, no matter if you're the last check-in in the recent round, or if you're one of the early original backers 15 years ago, everyone's going to get affected by this transaction. So the founder, CEO, co-founding team, they need to be very clear in their communication to their investors, their cap table, their board. Everyone needs to be aligned. Ideally, it would be a scenario where everyone wins, everyone does well out of that situation. Sometimes you'll find that maybe certain investors don't do well out of a certain acquisition scenario. Sometimes key employees don't do well if there's an overlap, and there's part of the acquisition is to remove some costs and remove some functions that are not needed post acquisition. And if you don't have people aligned, then they're not necessarily going to be, incentivized for an outcome to happen in the way that, let's say, the founders or whoever's driving the transaction want it to. So it's never easy to get everyone fully aligned on everything, but you need to manage that.
Yeah,
that's a lot of communication, and you have to kind of take the employees and your investors along the ride for a successful acquisition. And then the other thing that's very important is how it's going to be perceived in the industry, the market, the ecosystem. So the actual stakeholders in the industry, regulators, competitors, customers. Customers is a big one. Someone's customers and regulators, right? So often you need to kind of have them involved in the process at some point.
Yep.
And communicate to them and kind of read them in. You may not give them the specific details, but let them know that something positive is going to happen, that you're working towards, that will really strengthen this group and this industry, and so that they are also not blockers and are on board. Customers often will transfer from one ownership, same company, but
to another,
different management, right? So they need to be read into the situation, and certain key customers, depending on the nature of the contracts, may have to actually sign off on it and agree and say, yeah, So you really have to understand the legalities, and you have to understand all of the stakeholders that kind of have some stake in the game.
Yeah. So Tariq, you are an angel investor. You're the guy that a lot of founders are looking to get in contact with, and I'm sure you get a lot of DMs on your LinkedIn. What are the key things that you look for when an investment is, a startup founder comes to you? What are you looking for in that kind of company for you to kind of get your motivation to kind of look into it in a little bit more detail and figure out whether this is the type of investment that you would kind of invest in?
Right. Yeah, it's a very good question. I mean, and it's very personal to every investor, whether institutional or individual. I mean, for me personally, a lot of my thesis is to invest in markets that I have knowledge in. So the UK, which I'm from, UAE, Saudi. I grew up as an expat kid in Saudi in the 80s, 90s. So these are countries I know well. I've lived and grown up. So that's a good lens for me. Things that are in those markets, interesting for me. I get things coming across my desk from all parts of the world, and if it's not to say that there are not good opportunities to invest in certain parts of Africa or Kazakhstan, Central Asia, but I just don't know those markets very well. So it's an easy filter for me. It's not for me. It could be for another angel investor that's very familiar with it. But once they tick certain boxes, stage and sector, I tend to look at fintech, health tech, B2B SaaS, some areas which I like and have got some good knowledge and some acquired knowledge. For me, often a lot of it comes through the introduction. So how the founder gets connected to me. Often if they're referred by people that I know, trust, other entrepreneurs, other industry experts or friends in an industry, other VCs, much more likely to look at them because it's important to know someone's background and due diligence. So that for me is usually the best channel. I get a lot of cold approaches on LinkedIn. It might work for some people. It just doesn't for me because I don't have enough time to do due diligence on individuals. And I usually like that referral. When it comes to
people are going to DM me and then I'm going to introduce you, right? On LinkedIn.
Yeah. But if it comes from you and you vetted it, I'll take a look at it. You have to draw the line somewhere, right? Because otherwise, if you have, if you a big VC with 3, 4, 5 different people full time on it, then then you may have the resource to do a bit of due diligence. You may have other tools at your disposal. But when you're an individual angel, time is limited, time is precious. But once this comes through a right channel, I feel comfortable. Often with the founder, I prefer co-founding teams, although I have backed solo founders. But that would be a preference because then it's a hard journey, entrepreneurship and building a business. So when you're on your own, it can be, there's a lot of uncertainty, a lot of anxiety, there's a lot of stress, it's good when you're able to share that with 1 or 2 other co-founders, and the other co-founders bring something different to the table. One could be an extrovert and a good leader, good communicator. Someone else could be very technical. Someone could be very good organization, financials, operations. So you need a blend of different talents at different stages. their personal story is really important. What drives them? What kind of person are they? What's their backstory? Why are they passionate about this particular problem? I prefer it if they have knowledge of a particular industry. I know there's two schools of thought, right? So an industry outsider coming in to solve a problem might see things and do things and disrupt things.
Do things differently.
Yeah. Personally, I prefer someone to have some knowledge of an industry and have been there, because then they understand the intricacies, the kind of the hurdles they need to come over. They understand the regulatory implications and things that have worked, because those conversations within an industry at industry events and trade fairs, you tend to get a good sense of what's working and what people understood are not working, right? So someone with industry knowledge, I think, for me, is very important. And increasingly, entrepreneurs that are good people, humble, they really are humble, that don't profess to know everything, but are really on a journey to a growth journey for them personally, to personally grow, to learn, and to prove or disprove a hypothesis, and that they're very inquisitive. And I find that those entrepreneurs are usually the more quieter ones, more humble, more stable. Those are the ones that will attract other people to join them on their mission, employees. Those are the ones that tend to gel well with investors. You need to be firm, and you need to have a clarity of vision, but kind of staying rooted and grounded, and staying, the worst thing that can happen for a founder is someone that is blindsided by ego and thinks that they know things, and actually then they can really get blown off course and go down an ugly path. So those are typically the things I would look at in founding teams, entrepreneurs.
No, thanks for sharing that. I think we're going to get loads of DMs after this, so be ready. One of the things I also want to kind of do a quick deep dive into is, one of your expertise in many things, CFO, angel investor, COO advisor, but you also got a lot of experience in healthcare as well. You mentioned you was one of the founding individuals, with Cleveland Clinic in Abu Dhabi, which is massive, highly reputable institution. And you worked obviously in Dubai as well. And you're currently working for, a health tech company that kind of focuses on mental health. So you, as a expert in healthcare, how do you see the industry kind of playing out in this region particularly? And where do you see the opportunities? Obviously, if you compare, this region is very different to where we're from, right? Because we grew up in the UK, and you've got the NHS, and that's a government funded institution. You go places like the US, and it's a similar system to the UAE, where everyone has to get medical insurance, and you got to pay for healthcare, and it's quite expensive, and some people don't get that treatment. How do you see things in this region? What kind of experiences can you share?
Yeah, so healthcare is has become bread and butter for me over the last 20 years. Very blessed to be involved with some really exciting, successful projects, which is more by fortune than by design, to be candid about it. And again, I'm currently working with a really exciting group, NeuroCare, to build their mental health platform across the region. They're a global company out of Europe, and have been backed by a very prominent leading healthcare private equity firm who I've known for many years. Great team. Really have a lot of respect for them, and it's just been a matter of time to do something with them. We've been friends for a long time, so very, very exciting new chapter. I think healthcare, there was, in the region, and this is a long conversation. I know we don't have much time left, but this is probably another podcast. But kind of a couple of thoughts on it. I mean, the region, has been building a lot of healthcare infrastructure for the past 2 decades, 20 plus years. A lot of it led by Dubai Healthcare City, and then Abu Dhabi and Qatar and Saudi, and much of it has been backed by kind of sovereign wealth fund or public sector investments in infrastructure, hospitals, tertiary, quaternary care facilities, mobilizing the private sector to build clinics and primary care hospitals. And secondary care hospitals and general hospitals. And so a lot of that infrastructure has been built.
Yeah.
And I think COVID really changed the game a lot. I mean, the regions, the population of the region have always been very health conscious, and they really demand really the best healthcare possible. The nationals and even the expats that have been here for a long time, long-term expats. And so public sector kind of approach doesn't really work here, right? You need that patient experience, that customer experience, the nice facilities that maybe it's more care focused in the UK rather than the facilities themselves. They're a much older institution.
Yeah.
But what changed in COVID was that I think people started to really appreciate the need to take care of their own health. Mental health became a big kind of, let's say, hidden pandemic that was recognized governments globally. People were locked away on a lot of devices and a lot of technologies. They were kind of we were removed from society for a period of time. The youth are coming through with social media and growing up with tablets and devices and mobile phones attached to them. So mental health has become a huge. It's always been there, but I think the awareness around mental health has kind of really grown exponentially out of COVID. I think longevity is another area where people are more conscious of their health. There was different views on taking vaccines and ingesting medications, and on top of the opioid crisis that we had in the US. So people are now conscious of what medication they take, trying to monitor their own health, wearables, CGMs, continuous glucose monitors, and so people really want to take control of their health, not be reliant on a system or doctors, so that their kind of well care or wellness is in their own hand, and that kind of broadly sits under the umbrella of longevity. Metabolic disease management, which is a big issue in our region, diabetes, sugar intake, etc. So that's another area where people can take ownership. So there's a lot of interesting areas that will play out, and COVID was really an accelerator for that. Remote care, home care, people taking ownership of their own care. All these things really came out of COVID. So interesting time, I would say, in health tech and health innovation in general. And now that's the layer that will be interesting in the region, because a lot of the infrastructure has been built and has been there, from the first phase of the development of the healthcare industry.
Thank you for sharing that. Thank you for being a guest today. What's the best way that our audience can get in contact with you? If
I say LinkedIn and don't reply, I'm in trouble. We can pass out my work email, or they can contact me through the Janus Ventures website as well. Good to be here. Thanks for the chat.
No, it's been great. Thank you very much.
Yeah, enjoyable.
Thank you for joining us on the Alphapreneurs podcast. I hope you enjoyed the show. Please subscribe and give us a 5-star rating and a review. Your feedback is appreciated. For show notes and more, check out the link in the description, and connect to me directly on LinkedIn and search for Rayhan Aleem. See you in the next episode.